Hi. Let's learn about expansion in economics. Expansion is the phase of the business cycle where real gross domestic product grows for 2 or more consecutive quarters, moving from a trough to a peak. It is typically accompanied by a rise in employment, consumer confidence, and equity markets, and is also referred to as an economic recovery. The economy is believed to follow a cyclical path, known as the business cycle, with 4 distinct, identifiable phases. Economists, policymakers, and investors closely study business cycles by looking at expansion and contraction patterns of the past to forecast potential future trends and investment opportunities. Expansions last on average about 4 to 5 years, but can range from 10 months to over 10 years. The National Bureau of Economic Research determines the dates for business cycles in the United States. Leading indicators such as average weekly hours worked by manufacturing employees and new orders for consumer goods can provide clues as to whether an expansion or contraction is occurring in the near future. Capital expenditure and interest rates are the 2 main forces that best determine corporate profits and the state of the general economy. Leading indicators such as average weekly hours worked by manufacturing employees, unemployment claims, new orders for consumer goods, and building permits all give clues as to whether an expansion or contraction is occurring in the near future. Capital expenditure, the money companies spend on maintaining, improving, and buying new assets, and interest rates, are the main forces that determine corporate profits and the state of the general economy. The Federal Reserve, Fed, cuts interest rates when the economy needs a lift, encouraging businesses and consumers to spend more, and money flows freely through the economy. Companies take on loans to fund expansion, job prospects improve, and consumer spending increases. However, the cheap flow of money and subsequent increase in spending will cause inflation to rise, leading central banks to hike interest rates, which eventually causes the economy to contract again. Cycles move in tandem with company attempts to match ever-changing consumer demand. When the economy is growing, management teams seek to capitalize by ramping up production, which leads to higher sales and returns on invested capital. Eventually, supply outstrips demand, prices fall, and companies are left with no choice but to lay off staff. Here are 3 key takeaways. 1. Expansion is the phase of the business cycle when the economy moves from a trough to a peak. 2. Expansions last on average about 4 to 5 years but have been known to go on anywhere from 10 months to more than a decade. 3. Focusing on interest rates and capital expenditure can help investors to determine where we are in the business cycle. Hope this would help. Thanks for watching.